Picture this, a luxury yacht anchored off the coast of Necker Island. Inside, 3 billionaires signed documents that will legally erase half their net worth from government databases by sunrise. This isn't a thriller plot. It's Tuesday for the ultra-rich. While you're stressing over market crashes, they're using 12 banned tactics to make wealth disappear, regrow. Let's start with the method so potent. Panama Papers investigators called it financial HPI, untraceable and incurable. The first layer of this shadow system, offshore trusts masked by anonymous shell corporations. Most people think tax havens are just tropical islands, but the real action happens in landlocked states like South Dakota and Nevada. Here, billionaires create irrevocable trusts that surrender ownership without losing control. Imagine handing your mansion to a legal entity you don't technically own, yet still living in it rent-free for life. The trick, choosing jurisdictions where trust details never expire. Now, add shell corporations like Russian nesting dolls. A billionaire's trust in Liechtenstein owns a shell in Wyoming, which owns another in Singapore. Each layer makes asset tracing cost millions in legal fees, a price only governments can pay, and only if they're willing to spark diplomatic incidents. But the real genius is something called a private interest foundation. It's not a company, not a trust, but a legal Frankenstein that holds art portfolios, private jets, even entire islands, all while bypassing inheritance taxes completely. Congress tried to kill this system 3 times, failed every single time. Why? Because the ultra-wealthy exploit a loophole older than income tax itself. Sovereign states can't regulate each other's financial laws. So when Nevada decided trusts could last 1,000 years and ignore foreign courts, billionaires worldwide pounced. The result? But this is just the foundation. What happens when you combine these ghost entities with investment vehicles banned in 47 countries? Vehicles that let fortunes grow tax-free for decades, shielded from divorces, recessions, even criminal charges. Because right now, 9 families you've seen on magazine covers are using these exact structures to outlive governments, lawsuits, and time itself. The question isn't whether you can replicate it. It's whether you're willing to learn rules written in invisible ink. While ordinary investors scramble for stock tips, billionaires play a different game, one where the board isn't public and the rules are written in disappearing ink. Take private equity funds, the ultimate money velociraptors. These aren't your retirement accounts index funds. They're invitation-only pools where the ultra-rich buy stakes in startups years before IPOs, turning thousands into millions before retail investors even get a whiff. But here's the kicker. These funds use evergreen structures. Unlike mutual funds that force yearly tax hits, evergreen funds recycle profits into new investments indefinitely, delaying taxes for decades. Imagine compounding wealth without the government taking a bite every April. Then there's the dark side of trading. Not the medieval torture chambers they sound like, but private stock exchanges where billionaires move billions anonymously. Public markets, too slow. In dark pools, massive trades happen in milliseconds. Prices manipulated without alerting regulators. A single hedge fund manager once shifted an entire tech stock's value by 15% in one dark pool transaction, legally. How? These venues operate under trade reporting loopholes, allowing delayed or obscured disclosures. But the real magic is in carried interest loopholes. When private equity managers earn profits, they're taxed at a mere 20% instead of the 37% income rate. Congress has tried to close this for 50 years. Failed. Every time. Why? Because the loophole isn't a bug. It's the system's DNA. Meanwhile, average investors pay full freight on every stock sale. Now layer in royalty trusts. These aren't oil rigs or patents. They're cash geysers. Billionaires park assets like mineral rights into trusts that pay them monthly royalties, classified as passive income, taxed lower than salaries. One oil heir collects $200 million yearly this way, paying a lower tax rate than his secretary. But we're just scratching the vault door. What happens when you combine these tools with assets that exist outside money itself, like 600-year-old violins or nude portraits of dictators? Assets that morph into financial weapons, bulletproofing wealth through chaos. That's where the game turns lethal, because while you're watching CNBC, someone's trading Picasso's Mistress in Geneva and rewriting the rules of wealth forever. Imagine owning a $68 million painting that's never hung on your wall. It sits in a Swiss warehouse, shielded from taxes, divorce courts, and prying eyes. This isn't vanity, it's financial warfare. Billionaires turn art into shadow currencies through freeports, secretive storage facilities, where masterpieces gather dust but never import duties. Geneva's freeport alone holds art worth over $100 billion, all owned by numbered companies. When a billionaire needs cash, they sell the piece to their own offshore entity at an inflated appraisal, securing low-interest loans against an asset that technically never moved. But the real power lies in rotating collectibles. Take vintage cars. A Saudi prince once bought a 1962 Ferrari for $19 million, then immediately leased it to a museum he partly owned. The lease payments became tax-deductible business expenses, while the car's value ballooned to $34 million in 3 years. When he sold it to a Panamanian shell company, the profit was magically classified as a foreign capital gain, untaxed. Watches, wine, even rare books follow the same playbook. A tech CEO facing a lawsuit transferred his $200 million watch collection to a Bermudan private trust. Since Bermuda doesn't recognize foreign court orders, the assets vanished from legal reach overnight. And because these items are considered non-income producing, they're excluded from wealth calculations during bankruptcy or divorce proceedings. The darkest twist: death derivatives. Yes, death. Billionaires buy life insurance policies of terminally ill patients through viatical settlements, betting on precise death dates. When the patient dies, the payout is tax-free. One hedge fund made $400 million during the COVID pandemic by acquiring policies of high-risk individuals. It's morbid but legal, and shockingly common. Yet all this pales next to catastrophe bonds. These instruments pay returns when hurricanes hit or pandemics spread. During the last global health crisis, a single bond yielded 1,200% returns for investors who bet on maximum carnage. The sickest part: the money funding these bonds often comes from pension funds, meaning grandma's retirement is bankrolling bets against her survival. But the ultimate firewall isn't offshore accounts or Picassos. It's a tool so counterintuitive it turns debt into an immortal shield, a place where owing money becomes more powerful than owning it, and bankruptcy is a superpower. By the time regulators catch on, the game's already reset, and the rich are 5 moves ahead. Debt, the one word that terrifies the middle class but electrifies billionaires. Here's why. The ultra-wealthy don't avoid loans. They weaponize them. Take the buy, borrow, die strategy. Step 1. Acquire appreciating assets like real estate or private equity. Step 2. Borrow against them, at interest rates lower than inflation. Step 3. Never sell. When you die, your heirs inherit the assets at stepped-up basis, erasing all capital gains taxes. It's legal immortality for wealth, but the real power lies in cross-collateralization. A tech mogul once pledged his stock portfolio to 3 different banks across 3 countries, securing loans totaling 4 times its value. How? Banks rarely communicate across borders. By using offshore entities as guarantors, he created a daisy chain of debt that can't be called without collapsing the entire system. The golden rule: never use your own name. Always borrow through LCs, shielded by layers of trusts. Then there's the sovereign immunity loophole. Certain bonds issued by foreign governments can't be seized by courts, even if you default. A shipping magnate parked $800 million in Argentine sovereign bonds after his divorce. Since Argentina ignores U.S. court orders, his ex-wife got nothing. These bonds still pay 7% interest, all while being lawsuit-proof. Universities like Harvard issue century-long bonds at 3% interest. Billionaires snap these up, using them as collateral for lower interest loans. The spread becomes risk-free profit. Meanwhile, the bonds themselves are stashed in charitable remainder trusts, converting taxable income into tax-deductible donations. It's a financial algebra. Wealth eating its own tail to grow bigger. The darkest twist? Investor-state dispute settlements. By investing in countries via shell companies, billionaires gain the right to sue governments for laws that harm profitability. A mining tycoon once sued a nation for $12 billion because they banned toxic waste dumping. He won. The payout came from the country's pension funds. Yet none of this compares to the nuclear option: strategic bankruptcy. One real estate mogul structured his empire into 53 LLCs. When the 2008 crisis hit, he let 47 go bankrupt while keeping 6. Bankruptcy courts never saw the $300 million parked in New Zealand's zero-data trusts, entities so secretive, not even judges can demand records. Now comes the masterstroke, turning these tactics into generational shields. Foundations that pay salaries to descendants as employees. Grants that freeze asset values for tax purposes. Dynasty trusts that outlive civilizations. But the final move, the one that ties all 12 tactics into an unbreakable knot, is so counterintuitive, it redefines greed itself. And it's already being deployed in 7 countries you'd least expect. The 12 tactics form an unbreakable algorithm, a wealth matrix where every loophole exploited by billionaires feeds into the next. Let's connect the dots. Offshore trusts anonymize ownership. Private equity evergreen funds defer taxes indefinitely. Art and collectibles launder value through freeports. Catastrophe bonds profit from others' suffering. Debt strategies turn liabilities into immortality tools. Royalty trusts transform assets into passive income geysers. Dark pools manipulate markets invisibly. Sovereign immunity bonds defy courts. Death derivatives monetize mortality. Strategic bankruptcies vaporize obligations. Investor-state settlements. Dynasty trusts outlive civilizations. But the real secret isn't the tactics, it's the sequence. Billionaires never use one method alone. They layer them like financial Kevlar. A private equity gain gets funneled into an offshore trust, which buys sovereign bonds, collateralizing loans for art acquisitions stored in Geneva. Each layer multiplies opacity and tax evasion geometrically. Meanwhile, the average investor's diversified portfolio of stocks and bonds sits fully visible, taxable, and vulnerable. The final masterstroke, turning time itself into an ally. Grats freeze asset values for generations. 200-year mortgages stretch debt beyond lifetimes. Perpetual bonds outlive their buyers. This isn't wealth management, it's temporal arbitrage. While you plan for retirement, billionaires architect legacies that survive political regimes and climate disasters. Yet none of this requires a billion-dollar fortune to study. Panama's trust laws are public. Nevada's 700-page LLC statutes can be downloaded for free. The difference between you and a billionaire isn't access, it's obsession. They dissect legal codes like, so where does this leave ordinary people? Not helpless, just outgunned. Knowledge remains the ultimate leverage. You can replicate their moves overnight, but you can audit your own strategies for single points of failure. How much of your net worth is tied to regulated markets? How many assets could withstand a lawsuit or recession? The goal isn't to become a billionaire. It's to stop playing a rigged game with visible rules. One last truth. Every tactic mentioned is perfectly legal, immoral, perhaps unethical. The billionaire's greatest asset isn't their money, it's your ignorance. And after today, that advantage just evaporated.